Good afternoon and welcome to TradeStation's Market Action webinar. My name is Don Prattle and that handsome fellow in the chat panel that you see is David Russell. Today we're going to talk about price action and what the options are telling us about the broader market. We're glad that you tuned in and we hope that we entertain you. As you can see, I've been around for a while. That gray hair didn't come naturally. I earned every one of those. My career in financial services reflects a lot of different things but what I'm most proud of was all the time that I spent on the trading floor at the CBOE. Today we'll be talking a little bit about the stocks in my background, my history, that I filled as a floor broker execution specialist at the CBOE floor. I've got a number of licenses and I do a little bit of education in the local colleges, but that's not what we're here to talk about. The fellow here, David Russell, our VP of Content Strategy, is the real deal. He's going to draw on his decades of experience in financial journalism and as an analyst, and he's going to offer us his background on equities, emerging markets, fixed income, and derivatives. He's previously worked at Bloomberg News, CNBC, and E-Trade. We're very lucky to have him with us today here at TradeStation. David is going to review some of the global financial headlines today and offer up some of the indicators that he uses as he watches for some tradable trends that give us opportunities over time. Our presentation today is for educational purposes only. All the symbols, all the trading ideas, and everything that we discuss are for demonstration purposes. They are not recommendations. This is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Remember that active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for every trader. Now, I have included in the chat panel some of the disclosure information that's very critical to what we're talking about here today, particularly the characteristics and risks of standardized options brochure that comes from the Options Clearing Corporation, one of our regulators here, and also the other asset classes that we cover here at TradeStation. I may just post those again for you. As we move through the rest of these, I want to talk to you about the TradeStation Masterclass. With our TradeStation Masterclass, you can master TradeStation in just 1 week. This is a 5-day training session in Plantation, Florida, from January 28th to February 1st. I urge you to register now. Seats are limited, and you can learn more about study at tradestation.com/master-class. We'll offer you 2 days of TradeStation deep dive platform training, 1 day of strategy development and testing, and easy language fast track programming. There's a number of guest speakers that will come and entertain us in Plantation throughout the week. You'll be happy to know that we have some social events planned for you as well. So, master TradeStation in just 1 week. Join us for the Masterclass. Also, if you haven't read it yet, you need to go to insights.tradestation.com to take a look at our Market Insights blog. Most of the articles are authored by our content editor, David Russell, and he'll be showing you some of the key writings that he's posted there today. I know that a number of the stocks that we're going to talk about are things he's written about already. I want to turn things over to David right now and let him get set up and share his screen and so that we can get started with the TradeStation Market Action. Now, before David gets started, let me just point out we are recording this event. Everybody always asks that throughout the presentation. We are recording. It should be available early tomorrow on the TradeStation website, on the TradeStation YouTube page, and if you are a TradeStation customer, in TradeStation today. So, without further ado, let's turn things over to David Russell.
Well, thanks a lot, Don. It's great to be back with everyone. So I wanted to tell everyone right off the bat, if you go to tradestation.com, the main website, and you go to menu, and then you go to, it's right here, you cannot see, let me just make it a little bigger, Market Insights. This is the blog we're talking about, and we always put a summary up before the webinar, which is right here. If you click on this, most of the things we talk about are covered in this outline, this summary. We always start by looking at the S&P 500, and I want to point something out. There's a few indicators we've used many times on the Market Action webinar. And one of them is this kind of special little indicator I created Actually, I lost my logo. Let me just get that back. Good. There we go. All right. So, one of the indicators that I've kind of used over time, it only works kind of at certain times, but I have found it to be pretty reliable, which is it's very simple, but you look at how far the S&P is from its 10-day moving average. And you'll notice when it reaches these extremes past 3%, at least on the upside here, you can see that we're looking at, some kind of signals where at each time it does that, the market tends to kind of peak. And we're back to that level now. Now, this is simply a short-term indicator because it shows how far we are above the 10-day moving average. It can mean that the market will either, let me just kill that. It can mean that the market will either, drop in the near term, or it can simply mean the market will pause and that 10-day moving average will turn around and go back to the upside. It can go either way. The key thing is that it kind of signals a degree of being, overbought. Now, at other times, we had noticed, for example, that this was down at extremely oversold levels. And what's interesting is it kind of reached that right before New Year's, before Christmas. So we kind of see this, and I just want to point out right now, the basic thing I want to point out is that when we're way above that 10-day moving average, it's difficult for the market to keep pushing higher, especially when we have this kind of negative momentum. So in my view right now is we're going to just probably see some consolidation. And, in my view, we have the potential for a test of 50 to maybe 100 points to the downside at the most, depending on what happens. When we look at some of the things coming up in terms of the news, it could also favor that. So I do think it's also interesting. I want to point out here, let's go to the hourly chart of the futures. Now, remember, with futures, we can use the hourly charts more effectively. It's different than the cash index on when you look at an hourly chart because it includes 23 hours a day for futures. I want to just point out one of the indicators we have repeatedly used has been the 50-hour moving average. You'll notice right here it gave a nice buy signal, and then right here it was waffling. You can see that the way the market kind of, it flattened out. It's kind of sitting, but then it kind of consolidated right there above that 50-hour, and then we got a continuation to the upside. So I want to just point out once again that this indicator, since we've been doing market action, there's only been one time that this indicator really failed to provide any kind of signal. So I want to just kind of point that it continues to be useful. It is now indicating, potential, pretty much a kind of shift of momentum, more toward the upside. We're in a new quarter. Earnings are not that far off, and we've basically priced in a lot of bad stuff here. And, in my view, this is more time where money is going to be coming back into the market, looking for some consolidation. This sell-off going into Christmas Eve was kind of one of these freakish things that can happen when the market is quieter going into the holidays. And in my view, this probably was the end of the selling. Now, there are still some other issues that can happen in the near term. For me, in the very near term, I'm actually seeing more of a bearish sort of setup news-wise. The reasons is that, we're going to have apparently news out of China tomorrow. I don't know. I mean, it's a vice ministerial meeting. I'm not a political scientist, but I would tend to think that they're not going to strike a deal right now. They have a deadline until the end of February to do this trade deal, and it seems to me unlikely that they're simply going to reach a deal right now. So I think there could be some more kind of rhetoric. And then President Trump is going to give some kind of Oval Office address tomorrow night. It's going to be about the shutdown and all that stuff. To me, I would tend to think that he's not going to make an Oval Office address if he's going to be backing down or something. I would tend to think that we're going to see increased sort of rhetoric about the shutdown. So from my point of view, for the next day or two, we're way above that 10-day moving average. We've had a good bounce, and now I see the potential for a little bit of negativity. So my view here is that it makes sense just to be looking for a chop down toward 2,500 or 2,450. Now let's take a look here at the hourly chart. This 2,450 level kind of emerged. It was interesting. It came down and kind of held this level right after New Year's, and it's an interesting sort of level when you look at it overall. I'd been kind of looking, back in November, I was basically saying that we were looking for the S&P to go to 2,500, and it went straight through that during that week period of Christmas. But I think right now, right around this kind of 2,500 really is the area. To me, it always was my target ever since the volatility started in October. I was always looking for 2,500 because it was a level from late 2017 that to me made a lot of sense. And at this point, it looks like the negativity is fading at that level. However, it takes some chopping after this kind of massive sell-off. To me, a rally straight back up is not the thing to be expecting. And at the same time, when you think about it, like I said, when you look at China and the government shutdown, it just seems like we're not out of the woods yet in terms of like scariness. And then we still have like over a week until earnings really start flowing. So for me, that's just kind of my near-term kind of outlook. However, I am still looking to be buying on these drops here. And I'm looking now, really, one of the articles we did today, if you look over here on Market Insights, was an interesting outperformance in small companies. So basically the Russell really came to life, but also not just the Russell, a lot of the the smaller NASDAQ companies, especially biotechnology companies, smaller software companies, these seem to be the areas where people are coming to look. And why? I mean, when you look at some of these software companies that we're going to be mentioning, but some of them include companies, like a company like Shopify or Okta, Twilio, Etsy. Etsy is not exactly software, but these are not companies who are going to have a lot of risk geopolitically. These are the kind of companies that, I'm not going to predict anyone gets bought, but these are the kind of companies that are likely to be viewed as targets. We're moving into a period now where we've seen a couple of M&A in the biotech space this year. A lot of companies are down a lot. And, now is going to be the time where I think we're going to start to see more of this sort of speculation over M&A and stuff like that. That's going to favor the smaller companies. Furthermore, I want to show you the radar screen. I don't actually have it set up right now. I took a screenshot of this, but I want to point out what we did here with this radar screen. I basically, I like to rank things over different time frames. And if you look like 6 months, which is essentially, since the second half of last year, you can see the smaller companies, the IWM and the NASDAQ Composite, they lagged. And then it was the boring companies, the safe havens, that did well. What's interesting is if you look in the last 2 weeks, which roughly maps back to Christmas, you'll essentially see here that everything is flipping from safe havens to now we're looking to risk on smaller companies. And this sort of makes sense at the beginning of a year. And in my view, this is more the way we want to be thinking now. I've also seen some interesting sort of economists talking about the fact that some of the really big companies, the big S&P, the Dow companies, they're actually not doing as well in this economy as smaller companies and small businesses. Now, it's just something to think about, and it just kind of means that, I think there's a sense that is spreading. This came from there's an economist at Citi. I don't have her name, but she was talking on CNBC, and it was an interesting comment because it has matched certain things that I've been seeing and writing about in terms of the economy. So I think, we're going to see this shift toward the smaller companies, some of these growth stocks that are the smaller software companies, not the Microsoft. I mean, Microsoft doesn't have the same China risk or things like that, but we're talking about the smaller companies that are kind of like under $20 billion, that are growing fast and don't have that kind of global risk. Money's kind of shifting toward them, towards some of the biotech companies, smaller e-commerce names that are not going to have that same sort of issue. And I think we see the potential now for money to be draining out of FANG, money to be draining out of your Facebooks and your Apples and into your smaller kind of companies. And I think that's kind of what's going to define, sentiment and price action for the next few weeks at least. It's also interesting, I want to mention here, if you look at volatility, I don't have, I can actually show this on a very quick chart. I have a little study here that I call, it's a very simple study. It just shows 1 day price performance. So I can just add it. It's called 1D. I'm going to show you a little thing that's pretty interesting here. If you go to like 1D, actually no, it's 1D net points. Okay, this shows how many points something moves. And then what I did was, if I change this now to the VIX, and then if I change it to weekly instead of daily, what you can see is this point decline in the VIX. It went down 7 points last week. That was the biggest decline since mid-February, immediately after the big crash. So we're starting to really see the volatility get sucked out here in a way that we did not see before. Volatility stayed really elevated here. We're starting to actually see more of a drop in volatility. One of the other things we talked about in one of our last webinars, when we go back to, let me just make this go away. So late last year, we were talking about the yen and we were seeing upside in yen futures. And I mean, I didn't expect it to go up this much, but we had written about it and we had some articles about it. But this looks to me kind of like a ludicrous sort of top in the yen. You know, we wrote about this article here back on the 20th. That's why I want to encourage people to read Market Insights. We can only do the the webinar once a week, but this is something that is always hitting on the TradeStation website on Market Insights. We're always putting stuff up. And so basically, you know, we'd written about it way back here, and it's just interesting that, to me, I think when you see bearishness in the market, there's a natural correlation to the yen there, and I think a lot of people saw, wow, the VIX is really high, everything's getting hammered, and the yen is not up, and it just created this like bizarre squeeze into the yen. But that looks to me like that happened, and in my view, this is kind of like that final move in the volatility. It's that kind of final ludicrous capitulation when everything just gets washed out. That is more what this looks like to me, because the thing is that the yen was really not. The yen has not been relevant now for years. There was a period when the yen was that leading indicator of bearishness, but it's not happening now. So when you see something like this happen, it really tells me more that this is not a beginning of a rally in the yen. This is, if anything, just the final working out of the bearishness. And I just want to point that out, because this kind of rip in the yen didn't make a lot of sense. It hasn't held, and putting all these pieces together, it looks like we're shifting back now to this sort of risk-on sort of sentiment. Okay, those are the main things immediately hitting my hitting my radar in terms of looking at the market. I also want to mention that we just kind of look at this. On Market Insights, we had been doing a lot of articles throughout December, basically highlighting this bizarre concept that the American economy was headed toward a recession. And it was just crazy. I mean, if anyone looking at the numbers, there's no evidence of it. And we wrote about this repeatedly. People were talking about recessions at the very same time that that the Atlanta Fed was raising its GDP estimate. I mean, so I just wanted to point out that we have been very much emphasizing the underlying strength in the economy, and we have a lot of articles about it. And it's one of these things right now where, when all the kind of dust settles and we get through the scaries and the volatility settles, it creates to me this sort of thing, almost like this sell-off recently is almost like a slower version of the October 1987 crash. And if you look at the way the market performed after that, it held its ground, and then it just ground up for then I'm not sure say it's going to go up for like 2 years straight, but like people are just so horrified and scared of it, and then after they just keep inching back, and that tells me here what I think we're going to be looking at. The employment numbers, people making a lot of money, all these things right now with wages and jobs, all of these are going to favor money coming back to the market. But I think some of the big narratives and some of the big leaders, the Facebooks, the Apples, these are so damaged technically that it's not going to go back into those. So we have to see new leaders emerge, and that's the reason why we want to be looking at some of these smaller companies. I'm going to show you something here. I recently did a webinar about finding stocks that had golden crosses, or they were going to have golden crosses. We created a special scan that would find stocks that were going to have the 50-day moving average cross through the 200-day, and we could find it before it happened. Another one I came up with was a scan that finds companies that have a lot of revenue growth. So what this does is, this basically will look for companies. If we look at the actual scan here, I'm looking for companies that trade at least 500,000 shares a day, that are growing revenue 50% in the trailing 12 year over year, that trade at least 2,000 options a day. That's going to screen out a lot of smaller companies. I want to have them with a price to sales ratio under 10, because those would tend to be companies that might have a little not as fully valued. But I also, now the problem with this is you might find some company that when it took its revenue from like 10 million to 30 million, and it's like, who cares? So we also want to basically screen out companies with at least 250 of revenue. And what this basically produced, where's my, here it is, go away. So these are my names here. And it's interesting because we see some companies here like Tesla are on the list with a golden cross there recently. And I just wanted to point out, so these are just some of the names I've been working my way through and looking at. And I just wanted to say that these are some of the things that you can do with Scanner. Also, I was looking at some of the things in terms of companies that have upcoming golden crosses. And we do have some interesting names here as well that were also popping up. Interestingly, Nokia, this is a great irony. Nokia is on the verge of a golden cross at the same time Apple is getting hammered. So I'm just saying this is an interesting sort of historical anomaly. But like I said, I think there's going to be a period now where new winners are going to slowly emerge, and that's why we want to use the functionality that's built in the TradeStation more than ever. We want to be looking for companies, for example, that have revenue growth, companies making new highs, companies with certain technical patterns coming up, because those are going to be the things that actually the new leaders will emerge before our eyes. And I think that's the kind of environment we're in. Now, that's been some of the things that might be happening. Don wanted to take a look back at some of last year. One of my favorite calls that he made last year was in Pfizer. We had a lot of ideas of trading options on it coming out of here. I did pretty well with a lot of upside calls in Pfizer at various points along here. And he wants to come back to Pfizer and Merck. So, Don, what are you looking at right now in terms of your interesting names?
Thanks, David. I mentioned earlier that I was a floor broker at the CBOE, the Chicago Board Options Exchange, for many years before I became affiliated with online brokerages. And my deck, the broker's deck, generally included all of these names that I wanted to touch on today. Primarily, we were lucky, I suppose. Even the blind squirrel gets the chipmunk or the chestnuts once in a while. Merck and Pfizer greatly outperformed the marketplace in 2018. They're the top. They are top drug companies. So they are in a very healthy market for their products. Merck and Pfizer were outstanding performers in 2018. Merck was up 41, almost 42%. Pfizer had a gain of almost 28%. Now, the two drug companies were by far the best performing stocks in we would have called, I used to refer to my own stocks that I watched as the kennel. I've seen other brokers and other listings refer to these as the dogs of the Dow. But these two, Merck and Pfizer, were the best performing stocks in this 2018 group that I've picked out. They were strong throughout the year. Each one of them, they both ran into some selling pressure in December in sympathy to the overall market correction. Every stock was near their 52-week high at the start of December, and each have found support and have erased some of their losses from the first part of the month. Both companies posted better than expected earnings every quarter last year. I mean, I couldn't wait to bring them back as we move through the year with market action to describe, them and their earnings expectations. They'll both get a chance to impress us again in the final week of January with their next set of quarterly numbers. So if I had a trophy to give away today, this is not a participation award to these two. They both did very, very well. Now, two other stocks that did really well.
Don, do you think that Don, let me ask you, do you think these stocks are going to run into their earnings reports?
I do. I don't, as you pointed out, David, there's nothing to hold them back. They have, they were victims of the bad marketplace, the hysteria that involved the marketplace. They've shown strength even then. I mean, they fell and they didn't fall as bad as other companies. So no, I'm confident that they're going to perform very well in 2019 as well.
I wonder, because I like looking for calls on stocks that can melt higher into earnings, and just seems to me like both of these stocks might fit that bill. They have a lot of good options liquidity. It's a kind of company that sometimes you can look for out of the money calls, and you don't get the same time decay on them because earnings will actually hold up your value. So these are some names we might want to consider for that strategy.
Sure. I mean, last year was a particularly volatile one on Wall Street, and volatility does make for good options trades. That it makes for healthy premiums. So I think some of these stocks that I have on my list managed to close out the year with, across the board there was a gain of like 2% for all 6 of them, but they all, if you remove the dividends, they only lost 1.1%, which shows the power of dividends, but it also shows that the stocks on their own would have fared better than the overall market during the year.
I love how Merck in particular is sitting at that 50-day moving average.
Yeah, right.
Look at Merck, the red line on my chart.
So anyway, I think pharmaceuticals will continue to do well. They spend a lot of money. These two spend a lot of money in research and development and advertising and marketing, and their distribution channels are solid. So we can look for them to perform well in 2019 as well. Two other companies that outpaced the market as well, Cisco and Verizon, were both up strongly for the year, with Cisco rising over 19% and Verizon up almost 15%. For Cisco, the stock was very strong throughout most of the year, but the shares once again took a big hit during that December sell-off. Cisco had a December high of 49.14 on the 4th of December, but by the end of the year, the stock had fallen back to 43.33. Now, the stock has already bounced from its December low. Shares were trading at a forward PE of just 12.9, and it should continue to erase its recent losses, barring another big dip in the overall market. Verizon, on the other hand, was weak in the first 4 months of the year before taking off over the summer and trading steadily higher between May and then the start of December. December was tough on the stock, but gains from earlier in the year kept the position solidly in the green for the whole year. So if you owned Verizon, good for you. Cisco is going to report their earnings on February 13th. Verizon is going to report on January 22nd. And in answer to Jackie's question in the chat panel, sorry, we don't have a call-in number for the listeners. You can switch to your cellular by phone by logging in and leaving and relogging in as a phone user.
Excellent. There also will be a replay, as Don mentioned, on
right.
the YouTube channel tomorrow, which might be easier to listen to.
All
right. Well.
Yeah.
We're gonna keep going, Don?
Yeah, sure. I have no problem with that, bud. Coca-Cola and Procter & Gamble, they don't really seem like they fit together very well. But I tried to create a spectrum here in my sequencing, and Coca-Cola and Procter & Gamble both had modest gains in a down year for the market. Coca-Cola rose about 8.5%. Procter & Gamble appreciated just over 5.5% for the year. Coke had a rough first 4 months of the year, but the stock started trending higher in May and then enjoyed some pretty big gains until a sell-off in December with the overall market. It's like a broken record kind of scenario for me. The company has posted better than expected earnings and sales in each of the last 3 quarters, with earnings rising despite consumer shift away from sugary soft drinks. You'd never know that around our office, though, would we, Dave? I mean, we do drink a little bit of sugary soft drinks. Procter & Gamble also struggled in the first part of the year before posting some pretty strong gains in the second half. The stock did sell off with the overall market in December again, but it was not a very long-lived one for them. The stock has already started to make back some of those losses. In October, the company topped estimates on both the top and the bottom line, which shot the stock sharply higher. So the company is going to report again. Their earnings, report is due on January 23rd, and Coca-Cola should report on January 29th. Now,
Excellent.
I've got a couple losers here.
Hey, Don, let me jump.
Yeah, sure.
Here, John, we'll come back to those. Let me. I wanted to actually show people this thing that we did recently. We had talked about. What's interesting is, one of the biggest things that's been running in the last few weeks has been the Brazilian ETF. And so every week I kind of do this little thing called my workspace of the week, and this is available to people who email me at the email that's included here. And drussell@tradestation.com. If you email me, I'll send this to you. And this is my workspace of the week. Now, this is very much set up for country ETFs. It's kind of very unique for this. But the nice thing about this workspace is you can change other groups. So for example, right now, just for fun, I'm going to go and I'm going to dump, for example, like the NASDAQ into it. Add symbol list NASDAQ 100. Okay. So what does this thing actually do? Let's go back to the beginning here, just the countries. This will tell me, for example, it will allow me to rank them by the performance in the 2-week and the monthly period. And we can see here that like the Brazilian and the Mexican ETF are kind of at the top of the list. Now, what is this list of ETFs? These are all the country ETFs that I am aware of. I keep these lists. They're not always exactly up to date, but we have, our Mexico, our Brazil. We have like China in here somewhere, FXI. We have the United States as the SPX. Now, there's another indicator here that will allow us to identify basically which ETF is above its 50-day moving average versus under. Now, the nice thing about this is you can just go in here and you can change this indicator, and this is set up for the 50-day and the 200-day. So this is going to show when the 50 days over the 200-day, but you can then change those inputs. So for example, you can see here with Brazil, it's over, that moving average. So you can now do this, like here I imported, for example, the members of the NASDAQ, and you can see that, of this, these are the names in the NASDAQ like ADP or Amgen that are over the 50 days over the 200-day. Now, obviously, this is very one size, fits all, right off the bat. But the thing is you can use radar screen for some really simple stuff. But when you really think about it, when companies, for example, are in an uptrend, if you want to compare, price performance over different time frames, with a workspace like this, you can change the list. You can just, you can copy it and then have different versions of it. You can change the parameters. You can change this to positive MACD or bearish MACD or a lot of other things. I just wanted to point this out to people that, this is some of the ways when you use your symbol linking and you use different kinds of lists that allows you to find some areas of outperformance. I'm generally, a trend following kind of person. I want to look for areas where we see relative strength, and then we look for that to spread. Relative strength will show up in the numbers very simply using radar screen. It will show up in the performance. It will show up in the moving averages. So I just want to point out, this is available this week. This is our workspace of the week that is available. We try and do this now with market action, because remember, one of the things is if you go to masterclass, you can make these things in like 10 seconds by the time Mike Burke and Jesus are done teaching you. So the thing is like, these are just an example of some of the things. A lot of people really don't realize that with TradeStation, you are getting analytical stuff for free, basically, that other people used to pay a lot of money for. And I think a lot of people don't realize how much is in this platform. I mean, there's analysis that you can do. I know people who they go crazy putting stuff in spreadsheets and ranking this and ranking that. With radar screen and like a few lines of easy language, you can do all of this stuff, or a huge amount of it. And the great thing is all these lists, you can just import all the healthcare stocks, all the energy stocks. You can exclude this or exclude that. And then like I showed you here, when you do things like Scanner, you can find a bunch of items, and then you can copy them from Scanner into radar screen and then put indicators on them. And everyone can kind of do it their own way. I mean, it's no one size fits all, but it's one of those things where it empowers the average, individual investor to do a huge amount of research. You can cross-reference, for example, companies that might be growing revenue fast but have pulled back to the 50-day moving average. You can code things like that really easily. I mean, I'm not a developer, and I figured this stuff out just by messing around with it. So I just want to just point this out. These are some of the things that are available. We'll share this this workspace if you email me at drussell@tradestation.com. But really, it'd be great. just to think about like the master class. We're doing one at the end of this month. We have another one coming up at the end of March, I think. So, it's just one of these things where we're always looking to kind of be, showing people some of the other things. Also on my radar screen, I kind of have a list. I'm using the same indicator here because, most things in the market now are under their 50-day moving average. The market, obviously the S&P is, under its 50-day. Things have gotten beaten down. But I have this special list of ETFs, which are, different industry things. So FDN, this is an ETF that's the big internet companies like Alphabet and Facebook. Then we have like these different ETFs. So what I did was I said, show me the ones that are over their 50-day moving average. Let's see who's doing the best in the last week or so. And what we're starting to see is biotech. Boom, right at the top of the list. Look at this move in the biotech ETF. Now, the thing is that biotech is kind of a swarming sector. And, it has been weak really ever since 2015. So I have been waiting and waiting for the comeback in biotech. And we did a morning market briefing on Friday, and this was when Celgene got bought, and we said Exelixis. Exelixis is an oncology stock that, this company made a ridiculous move a few years ago, and it's just been consolidating ever since. It went from like 5 to like 30. I was buying this on Friday. And what's also interesting is if you look at my golden, I don't want to go back to it, but this stock now is going to have a golden cross. So we have this scanner that will find stocks that essentially are over the 200-day moving average, but the 50-day is still under. So here's a stock that's gone nowhere for years. If you actually look at it, this stock hasn't gone anywhere literally for 2 years. Look at its current price. It goes all the way back to February of 2017. I can't believe 2017 was 2 years ago, but that was, So this stock has gone nowhere, and now we're seeing biotech come back into favor. We're seeing oncology stocks get bought. These are some of the things that are on my list. So I wanted to point out we see biotech doing well. But then we also see something else that's just kind of interesting, and those are the home builders, ITB. I wanted to point out the ITB. Don was talking about it a lot last year. When you look at it, we have a few things happening here. We have the ITB, like the indicator says, it's over the 50-day moving average. We also have a low here, but MACD makes a higher low. That's called bullish divergence, which is a reversal pattern. And when you consider the fact that the trend has been bearish, a reversal pattern would mean bullish. It's also interesting here that we see a level right around 29 on ITB that it's holding. Now, also, there was an upgrade today on Masco. I can't even remember who did it, but it's interesting. Masco makes they're a supplier. They're in the ITB, I believe, but they supply like cabinets and stuff. They're housing related. So there's a lot of negativity toward housing here. And I just think it's interesting when we look at this. The ITB very often will move on a year-by-year basis. If you look here in 2017, it moved higher in the new year, and then it had a crazy year. Then it broke lower as soon as 18 began, and it just died. Now we're in a new year. It's back over the 50-day moving average. A lot of bad news priced in. I think it's just kind of interesting, and I did want to point that out. Now, wanted to get back to some others that Don had because he had, ITV was a loser last year, and so was Chevron, so was Exxon. Don, what are you looking at with big oil?
Yeah, I did not bring up any of the recorders that, the contractor companies, the builders that we talked about throughout the course of the year. Thanks for reminding me. Chevron and Exxon underperformed as oil prices went sliding. Oil and gas titans, they're the titans, the Chevron and Exxon. They performed well through most of the year, but as oil prices fell off in the fourth quarter, these stocks took really big hits and dropped to a 52-week low during the final week of the year. So they... let's see. So Chevron closed out the year down 7%. ExxonMobil lost 12%. Oil continues to fall as the market worries about oversupply and potentially lower demand as global economies are starting to show signs of weakness. Russia hit a post-Soviet record level of output last year, and the U.S. became the world's biggest crude producer during the year with 11.6 million barrels a day. higher than Russia and higher than Saudi Arabia. With all three countries near record levels in output, oil prices have just fallen drastically. Now, from a consumer point of view, we're looking at lower prices at the pump, but it is crushing these big companies that because they're at the mercy of the market as it gets pumped out of the earth. So Chevron and Exxon, it remains to be seen where that market's headed, David. I don't know. They are not healthy. The geopolitical forces that surround them are well out of their control. Now, two more.
Yeah, I'm looking at this myself, and I'm just myself wondering, does oil go back over 50? I am not an expert on oil at all. I've made some good calls on it on Market Insights just from being able to use some of the indicators in the TradeStation platform. Most people I know who like oil think it's going to, who follow oil in a more professional way, think it's going higher. I don't know though. I mean, to me, I just look at there's a big chunk of nastiness here, right between 50 and 55. And, I do wonder, I'm not sure, but I do think that, from a trading point of view, there is going to be another push down in the energy stocks, I think. XLE. The one that trades a lot of options is XOP. This trades a lot of options. It has good options liquidity. I'm watching this one to get short. I'm not sure when it is yet, but I think people who want to, trade momentum, there is going to be almost certain, I don't want to say almost certainly or anything like that, but odds really do favor, a momentum trade to the downside in energy. And I'm not saying now's the time to do it. I don't know what to think, but I do know this trade is coming, and I know I'm going to be watching for it. So Don, what I'm sorry, I just wanted to mention that energy.
Yeah.
You talk about IBM, right?
Yeah, back in the day, David, this was Big Blue. The market went the way Big Blue went. Everybody, it was part of every institutional trader's basket of trades. It would lead the market. We all waited to hear the earnings every all the time. Pricing in IBM was critical to the rest of the marketplace. But IBM and General Electric are those dinosaurs of the marketplace. Are both struggling, and these stocks both posted big losses for the year. IBM lost almost 20%, while GE shares were more than halved, with a loss of over 53% in 2018. IBM has long wanted to be a player in cloud computing and artificial intelligence, but has failed in both categories. The company looked to change that in 2018 by spending a boatload of money, $34 billion, in fact, to acquire Red Hat. I know you talked about that as something that didn't make a lot of sense. But that acquisition should have made IBM an instant player in the cloud, but it's going to be a long road for $34 billion to pay off, right? The other company,
a lot of debt.
Yeah, it's a lot of debt.
My biggest concern with IBM is debt and growth just don't mix very well, in my opinion, unless you have convertible debt, and I don't think IBM does. So
the last one that I'll touch on, the last one on my kennel that I'll touch on is GE. And, this company, Thomas Edison's company, has had an incredibly dismal year. The earnings keep falling sharply every quarter. The company was forced to slash its dividend for the first time from 12 cents a share to just a penny a share. Last quarter, the company earned 14 cents a share, which was 6 cents below what the consensus of the street was, and down 29 cents from the same period the previous year. That miss drove the stock sharply lower. It right now remains just above its 52-week low. So the best I can say about these guys is that IBM next reports earnings on January 17th, while GE will report on January 29th. We'll keep our eyes on them and see if they have any good news for the market.
Interesting. Excellent. Well, I have been looking at some of the newer companies that are out there. I'm just kind of looking for different things that have been doing some interesting things. And one thing to me is Twitter's a name that we've watched a lot, and we've seen some bullish options activity in. There has been evidence that they have been gaining market share against Facebook with advertisers. And there's a name here. I want to just show you that there's basically a channel that's formed here between roughly 25 and 36. You know what? Maybe I drew my. You know what? It's not 25. I took bad notes. I'm sorry. It's between 26 and 36. So basically, it's just interesting to see this. This kind of channel. I think you can see it. It's kind of the bottom, and then we have the top here. I think this is interesting because this is a stock that trades a lot of options. I'm not sure if it's going to break out immediately or what it's going to do, but there's a name here where I think a defined range is emerging here on Twitter, and there's going to be people trading up and down this range. And I do think we need to know about it. Now, looking for more on the growth side, there are several names here, and I think Twilio is one that kind of emerged as a big deal last year. This company is in a bullish descending triangle. I mean, even when the market was getting hammered, this thing barely went under its 50-day moving average, all throughout November period. It had a good earnings report, and it just held there. This is one to me where the next earnings are. I'm not sure exactly when it is in Twilio. It's probably sometime in the second half of. It's like mid-February, their earnings. But to me, this is a name I think that this is not a China name. This is not a there's nothing here that is touched or impacted by places where people are scared. There's a name that I think is interesting. Some other names these are like the smaller growth names, and they're on my list right here. If we look right here, Russell's watch list. But I mean, look at a stock like Okta. I don't even know what it is. But basically, this company has had just some really powerful numbers. And we look at this kind of, this is something you could see as a cup and handle pattern. If you read the book, I think it's called Making Money in Stocks or something by Jim O'Neill. But I mean, he's obsessed with these cup and handle patterns. But the thing is that for momentum growth stocks, this is something you want to look for. And it's basically when you have a big period of upside, a sideways period of consolidation and basing, and then this is the cup, and then this would essentially be the handle somewhere over here. The basic idea is it bases, then it makes a higher low, and then it continues the longer term uptrend. These are the kind of companies, though, that are in 3 to 5 year uptrends. These are the companies that go from 500 million of revenue to 3 billion of revenue in a 5-year period, and they go from like a market cap of like 2 billion to 10 billion. And those are the kind of names that that's growth, and that's real growth. And like everyone, got so obsessed with the FANG stocks, but the thing is that those are old now, and now we need to be looking for the new growth stocks. And the great thing is many of them have already been identified. Stocks like Twilio and Okta, these have started to get attention from the big wide world out there. Another one, which is I think, this is not as small of a company, but Salesforce is just this name is just unstoppable, and I like it. I mean, to me, this has been a stock that it's really gone nowhere for a while now, and it's had nothing but good earnings. Don was talking about it back here in earnings, and he was right. Great earnings report. It chopped, consolidated, and to me, this is a name here where it's also just has that kind of potential. One of my personal favorites is Etsy. I don't know much about the stuff they do in terms of I don't buy handmade purses or dresses and stuff. But here's a company that somehow has established a niche, and somehow they are really executing. Their numbers have been tremendous. This is one of those little companies people are going to look to as a growth story. And again, good earnings beat here, earnings beat there, earnings beat there. And look at it. If you look at it, it's not up that much from that earnings beat all the way back in June. So you're looking at a company now that has basically 3 good earnings reports, and only one of them is priced in. That's interesting. So these are the kind of areas I think that we want to be looking for. And one of the ways to find them is they're over the 50-day moving average, the indicator, like I said. So you could go to Scanner, and you could just look for, I don't want to do it all now, but, you could use the indicator here of stocks above OMA. In fact, let me just show you right now the easy language to this. Edit easy language. This is like 4 lines of code. Don't think coding is hard, because it isn't. So and I added this, actually, it's a little bit, I added to make it pretty. If I'm going to share this code here, basically what this does is it says, okay, what moving average, and then it defaults to the 50, but you can change it. And then what it says is, then here it calculates the average. And then if it's above the 50-day moving average, it just it creates a little message. It says above, because you can do like, you could do here, for example, 50-day moving average in this column, 200-day moving average in another column, and that way it will tell you each one. It will give you the message. It will say, oh, it's above the 50-day, but it's below the 200-day. The indicator creates the message right here with this little bit of code. It just, one little thing to be careful of when you're doing this kind of coding is a number has this numeric value, and text is called a string. So you need to do this little thing called this num_to_string. It's not hard. When you just start looking at this, you'll just realize, just use this example. And with this, what this basically does is this will allow you to find companies. So you can say, hey, let's find all the companies that are in, like the S&P 500 that are above the 50-day moving average, and boom, we start working down the list, start finding them. Or for example, you can do all symbols. You can do scanner, look for all symbols, find the companies that trade at least 500,000 shares a day that are above the 50-day moving average. That scan can run pretty quickly, and that's the sort of thing that you can do. In fact, I think we're going to do another webinar. People really liked our Golden Cross webinar recently. I think we're going to do another one in a week or two, showing some of these other ways of how to find those growth stocks. New stocks for a new year, I think we're going to call it. There'll be a webinar in a week or two, using Scanner to do some of these sort of tricks. So watch out for that. We'll probably put up a post on it. And if you email me, I can also email you information when we have it scheduled. But I wanted to just kind of point this out. These were some of the names that were popping up on my radar. I did some other stuff when I looked for other companies that had deeper pullbacks. And these were names, quite honestly, that I didn't find on TradeStation now. I found them before, and I just kept a list of them, and I just went back to my list. But some of these were names that were also interesting. For example, Carvana, which I bought on this last pullback. This company is growing really fast, and it was a crazy rally last year. And I'm looking for some potential of this to have some continuation to the upside. Some of the other names in this area that are this kind of smaller growth area would be names like Shopify, which does this sort of e-commerce. Had a really strong rally, way back in 2017, went nowhere all of last year, but it didn't go down that much. When you really look at it, when the market sold off in October, Shopify just kind of sat there. That is, to me, a bullish price action. This is the kind of name also that, I'm not saying it's just a buy here, just, pointlessly, but I mean, this is a company that, has a strong growth story. They basically do different things for e-commerce stuff. But again, if you look at their revenue growth, it's like, double, it's a strong double-digit sort of revenue growth. It's consolidating. No evidence that its business is weakening. It's just kind of consolidating. People didn't like growth stocks. It got forgotten. But like I said, these are the smaller growth stocks that I think we want to be looking toward. Also, I was looking at biotechnology, and these are just some names that I have kept over time. But Exact Sciences has also kind of had some, they've had several positive news events. If you look at the gap higher here, the gap higher here, but it's been chopping. The bearish market has held it back, but it's a biotech. It's oncology. Not saying it's going to get bought, but it's that kind of company that you could imagine as being on those kinds of lists that people are going to be looking for. Some others are IMMU. This was just another one that had a huge run up. Now, I want to be clear. I don't know exactly what's happening with this one, but it came up on my list as being one that had a big rally over the longer period, and now it's just kind of pulled back. So I want to just kind of point these out because these are some of the areas that were grabbing my attention. Also, last year was the best year of IPOs in several years. Now, there's been a general pattern that IPOs don't always perform wonderfully out of the gate, but some of these guys have now seasoned, and it might be time to come back and take a look at, for example, Spotify. Down a lot, but it is a growth stock that has pulled back. Another one that is interesting to me is Domo. This company it's just interesting. It's like there's this new tech thing happening in Utah. Domo and PS are both by these guys out of Utah. It's just kind of interesting, but Pluralsight is another one that's interesting. If you read about their business, I mean, I think this company has short squeeze potential. These are all companies that had positive news after their IPOs. They've seasoned, and they're probably worth taking a look at. I don't necessarily, like I said, I like to get my moving averages going. I like to see some levels, for me personally in terms of IPOs, and I just wanted to kind of revisit them. We cover them in different ways. We have our partner, Click IPO, that makes things available, and this year we're probably going to see some big IPOs, and it can definitely be interesting. People love to trade IPOs. I just wanted to revisit some of these that had done well last year. We also have our big Chinese names. People are coming back to these Chinese names to a certain extent. iKiwi and Huya, these trade a lot of options. The money has been drifting into them. They're back over the 50-day moving averages in both cases. IQ is not. But these are companies also that are just kind of interesting. So I think people are going to want to start looking to these. The other things that popped up on my list was the gold miners have formed a bullish ascending triangle here. And, we wrote about this at different times. I think right now, with the Fed having turned more sort of dovish, it's also interesting that one of the other points I want to jump back to here that I didn't cover that's higher up on my list is Europe. It's really not that bad over there in Europe. The Italians, the Italians basically didn't blow up their budget, and that's a big deal. Europe is also a huge oil importer. So with the sell-off in oil, it's a huge positive, for the European economy. There was some good data in November. And I think when we look at Europe overall, let's take a look here at Euro futures EC on the TradeStation platform. Someone asked me about this on market action in December, and I said, I really don't know what to make of the euro. And it has just kind of chopped and gone nowhere. Now, this is the cross. But I just think it's interesting if you look at the euro here. It's not really the most powerful level. I mean, you can say, yeah, it has some support here at this 113 zone. But I think when we look at it, this looks like it's turning to me. I am not saying it's a buy yet. I'm not really a currency guy per se. But the thing is it looks to me like we're entering a period of dollar weakness for whatever reason. And that's something that could be positive for gold miners as well. So I think we want to keep an eye right now, especially after that payrolls report. It was so positive that you don't want to just go out there and be buying gold. But I do think that, we had identified this bullish ascending triangle here. Silver has been moving as well. Like, this is kind of like energy to the downside. It's like a trade is coming. I'm not sure that we're there yet, but we should be aware of the fact that GDX is in a bullish triangle. And, this might have, continuation potential. It trades a lot of options. Another one that's in a bullish triangle, this is a smaller company, but I've been this is a name that I've thought is very interesting, is Glue Mobile. This company is a small growth stock. They do mobile video games, and it's just been a really powerful name. There's been a lot of positive catalysts on this. This is a bullish triangle here. You can also see something of a cup and handle. If you look, it's making these higher lows. It's also pushing right against this 8.5 level. Made a new 52-week high today when the rest of the market is not. That's something to look at. This stock looks to me like Roku did. Right. Where did Roku? Like right here. You could just have, we had talked at the time on market action about just chasing the upside in Roku. For something like Glue, in my view, it can do that. And Glue Mobile has been doing this all year when it kind of makes a new high and then it's like it just squeezes. I think this is a name here that is interesting, and it's been performing very well in a bad market for the last several months. Then to the downside, I have a few names. Mattel, just a disaster. A lot of debt, and for me, I'm watching for this maybe to get back to 12 and a half before I drop the hammer. Something as well like Smuckers. They've messed up like everything from what I can tell. They've done a really bad job managing a lot of their businesses. They tried to expand into pet food and they messed that up. Just a messy company. And then another one is General Mills. some of these are like the kind of losers of like the low carb diet, the just world. I just want to point these out. These are kind of dying stocks that have not done well, I think we just need to have them on our list for downside because there's just not a lot of positive stuff happening in some of these old-fashioned consumer staple stocks. So, all right, let's see. All right, those classes are fantastic. Can you have them outside the trading day? I think you're talking about masterclass. That's a good question. I'm not really sure. Mike Burke kind of runs all those, regardless, I look forward to seeing some of you guys sign at them. One or two of these.
We were talking about Dave. The question was
that, Don?
The question was referring to the to our Getting Started series. And I have posted in a couple of possibilities going straight to going straight, either signing up for the Getting Started series on the website or going straight to the YouTube channel to look up the older versions of those sessions. So that's, little housekeeping. Sorry.
Thank you for that. Well, those are most of the things I wanted to really just kind of hit on as I look back down my list. I think it's just important to realize, let's actually take a look at the S&P futures just to make sure nothing else happened in the after hours here. I'm just sitting and holding here. Like I said, I think right now, I don't think that this is a time to be bearish per se. I just think with the index at this level, it makes sense for me to look for chopping down, and it makes more sense right now to be looking for those names. We're at the point now when volatility is calming. When volatility calms, people move back into individual stocks, correlations drop. So right now is going to be the time when our new leaders are going to start to emerge. And that's why we want to be looking for some of these names that have been outperforming, stocks that are above the 50-day moving average, that sort of thing. That's now the thing that we want to be looking for some of the names that are going to do well this year. They're going to start to arise from the kind of ashes now. And that's what I kind of want to mention. So anyway, those are the main things that we wanted to cover today. Don't forget, Market Insights is here on the TradeStation website. If you go to the menu, you go to Market Insights. We're going to be back on Monday. I'm going to be down in Florida to do for masterclass, talking about some of the different ways you can kind of understand looking at stocks. I have a special way to talk about understanding kind of news flow, whether it's bullish or bearish and things like that. So those are just some of the things I'm going to be talking about. But we'll be back market action next week, and there'll be plenty of blog posts in the meantime before then. Thanks so much, and don't forget that Don's going to have his morning market briefing tomorrow as well. So thanks a lot, folks. We'll see you next week.
Thanks, David, for spending time with us this afternoon here in the Market Action webinar. I'm very happy to be able to work with you on the project. I hope everybody enjoyed themselves today. Come on back. Next Monday, we'll be here. And certainly, as David pointed out, every morning, 1/2 hour before the market opens, the Market Action webinar. I'm always here to greet you, and we'll get started with that 1/2 hour before the market opens tomorrow morning. Have a great night. We'll see you then.